90% of beginner investors lose their money in the first year. And honestly, it's not their fault. If you open up TikTok or Instagram right now, you're going to see a million self-proclaimed gurus telling you to buy stock because it's going to go to the moon, or because the price has just dropped and it's on sale. But if you're buying a stock based on a 5-second video, you aren't investing, you're gambling. In this video, I'm going to give you a simple 4-step checklist you can use on Yahoo Finance to analyze any stock in less than 10 minutes. By the end of this video, you'll know exactly how to separate a solid business from a sinking ship, using the exact data Wall Street looks at. No hype, no guessing, just real numbers and real data. Let's jump into it. Also, a quick reminder, this video is specifically for long-term investors. No day trades or swing. Step 1 of the checklist is checking the trend. When you type a sticker symbol into the Yahoo Finance, the first thing you'll see is the daily stock chart. Beginners obsess over the 1 day or 1 week view. If it's red, they panic. If it's green, they buy. I want you to ignore all of that and click right here on the 5-year or even the max view. What we're looking for here is a consistent bottom left to top right trajectory. Zooming out removes the daily noise and shows you the actual story of the company. If a company's chart looks like a roller coaster or a flat line over 5 years, that tells you the market doesn't have long-term confidence in it. We want steady, long-term winners for the highest chance of success. This is an example of a bad chart, a stock that seems too risky to invest in. But a great chart isn't enough. Sometimes the stock price goes up purely because of hype, while the actual business is dying. That brings us to our second step, the financials. Click on the Financials tab. This takes you to the income statement. Scroll down to the very first line, total revenue. Think of revenue as a total amount of money that company brings in from selling its products. Look at these columns across the last few years. You want to see the numbers climbing upward every single year like a staircase. If revenue is flat or shrinking, the company is losing its market grip. But here's the trap most people fall into. They stop at revenue. You must scroll down to net income. Revenue is the money they made. Net income is the money they actually got to keep after paying all their bills, taxes, and employees. If a company has skyrocketing revenue, but negative net income, they are growing fast but losing billions of dollars doing it. We want to see both numbers growing together. Great. The company is growing and making profit, but is the stock price worth it right now? Step 3 is checking the price tag, also known as the P/E ratio. Go back to the main summary tab and find the P/E ratio. This stands for price to earnings. Think of it as the multiplier you're paying for the company's profits. If a company has a PE of 20, it means you're paying $20 for every $1 profit they make. The historical market average is around 15 to 20. Tech companies and fast-growing businesses will often have higher PEs, sometimes 30, 40, or even 50, because investors expect massive growth in the future. But if you see a stock with a PE ratio sitting deep in the hundreds or worse, no PE ratio at all because they don't have earnings, that is a massive, massive red flag. It means you're paying an extreme premium, and if the hype dies down, your investment could hard crash. Finally, step 4, the safety net. A company can be making money today, but if they're drowning in debt, a bad economy can bankrupt them overnight. Click back into financials, but this time click on the balance sheet. We are looking at 2 specific lines: total assets, what the company owns like cash and factories, and total liabilities, what the company owes like debt. You want a massive buffer here. Ideally, a company should have significantly more assets than liabilities. Specifically, look at their cash reserves compared to their long-term debt. A healthy company has enough cash to survive a rainy day without relying on high-interest loans. So let's recap the 10-minute stock checklist. Number 1, the trend. Is the 5-year chart moving from bottom left to top right? 2, the financials. Are revenue and net income growing like a staircase? 3, the price tag. Is the PE ratio reasonable, or are you paying a massive hype premium? 4, the safety net. Does the balance sheet show more assets than liabilities? If a stock passes all 4 of these tests, you aren't just gambling on a trend. you are buying into a fundamentally strong business. If you found this breakdown helpful and want to build a data-driven portfolio without the social media noise, make sure to hit that subscribe button and drop a comment below on which stock you're going to run through the checklist first. Thanks for watching, and I'll see you in the next video. If you want more content just like this but in short form, make sure to watch the shorts.